Welcome in. My name is Arya and I'm a research analyst at FinChat, and in today's video we're going to be looking at 5 quality companies trading at their lowest valuations ever. Now, just as a heads up, if you prefer to receive this type of content in written format, we actually have a free newsletter which you could sign up for using the link in the description down below or over at newsletter.finchat.io. You go through the archives of all the different newsletters that we've posted over the years. And again, completely free. With that being said, to look at the 5 quality companies, we're going to navigate over to the finchat.io website. And if you already have an account with us, you could actually just click the dashboard button in the corner to get into the platform. If not, you're going to want to scroll down over to the search menu. And from there, we're going to look at the first of 5 quality stocks today, which is of course going to be Amazon. Now, once you've pulled in Amazon, you'll see that the analysis tab populates on your screen. From the top, you're going to want to select the financials tab. And then in the search bar, we're going to want to pull in the EV to EBIT multiple, which by the way, EBIT just is the same as operating income. And you'll see that over on a 10-year view, Amazon is currently trading at the lowest EV to EBIT multiple that they've traded at throughout their history. In order to confirm that, from the bottom right, we can toggle on the minimum line, and we'll see that the current multiple of Amazon is inches away from the lowest it's been over the past decade. Now, what's important to note with this is that it's not necessarily because Amazon stock is down a lot that they're trading at the lowest valuation. It actually has to do with their margins expanding over time. So we're able to pull in, for example, the operating margins of Amazon, and I'm just going to actually get rid of the decimal points here. And you'll see particularly over the past, call it 2 years or so, there's a strong correlation with operating margins increasing and at the same time, the valuation of Amazon going down over time. And actually, if we go down to a last 12 months view, whereby it adds the trailing 12 months of operating margins together and averages them out, you're able to more easily depict the trend of operating margins going up and the valuation of Amazon declining during this period. The next stock we're going to be looking at is Adobe, which recently has ran into some speculation by the market, deeming them an AI loser. Maybe not in the immediate term, but definitely in the long term, the market seems to believe that the rise of AI and new capabilities with video production can negatively affect Adobe's suite of products. If we actually go over to the overview tab and click on the drawdowns feature, we can see that Adobe is actually about 43% off of the all-time highs. And if we zoom this into the past year or so, you could see that it's down roughly 33% just over the past year. Going back to the financials tab, we're going to want to pull in the same EV to EBIT multiple. And so again, we're given the 10-year historical valuation chart of Adobe. Once again, we can confirm that it is in fact at its lowest valuation during this period. And I'm actually going to pull in the average line here. And you'll see that over the past decade, Adobe has averaged roughly a 41 times trailing EV to EBIT multiple. So as of right now, Adobe is trading significantly below their historical valuation range that they tend to trade at. It's actually even below the maximum drawdown they had in late 2022 when the entire market was going down. Next up, another software company that we're going to be looking at, and the third company on our list today, we're going to be looking at Salesforce. Now, because for the larger portion of Salesforce's existence, their income statement valuations have mostly been break even or even negative, we're not going to pull in the EV to EBIT multiple this time, and instead we're going to bring in the forward EV to free cash flow multiple. Now, admittedly, it's not at the lowest point of its valuation over the past decade, but it's definitely hovering near that sort of 19 times EV to free cash flow multiple that it bottomed at recently. Now, if we pull in the average line for Salesforce's EV to free cash flow, it is similar to Adobe, but not quite to the same severity. Salesforce is also trading at a discount to its average over the past decade. And similar to the Amazon case, but again, not quite to the same degree, the recent sort of drop in Salesforce's valuation could be attributed to a mix of the stock going down and additionally massive margin expansion, going from 20% free cash flow margins by the end of 2023 to 33% as of the most recent quarter. Now, perhaps another example that is a little bit closer to the Amazon comparison would be Uber, which is our 4th quality business trading at the lowest valuation this decade. You could really pick any valuation metric for Uber, and you'll notice that it has gone down over time because of the huge amount of margin expansion that they've done across all profitability metrics. But the one that we're going to be looking at today is the forward EV to free cash flow multiple, just to keep it consistent with Salesforce. And right away, you'll see that there is huge negatives and huge positives, again, due to the lack of profitability or just the low denominator that comes with these sort of valuation metrics. So what we're going to want to do is actually bring this in to start at the end of 2021. And so you'll see that over this period, Uber has gone from a forward EV to free cash flow of 140 times down to just shy of a 20 times multiple. If you want to toggle the mean line during this period, you'll see that they average a 34 times forward EV to free cash flow multiple, trading at a significant discount to its historical valuation. And then switching over to a last 12 months view, we're also going to search for free cash flow margins. And you'll see a similar trend to the Amazon chart that we showcased earlier. as margins expand to 16%, Uber's valuation has consistently gone down because free cash flows are technically growing much faster than the stock price has during this period. And last but not least, the final company that we're going to be looking at is Airbnb. If we simply pull in the EV to free cash flow multiple on a trailing basis, you'll see that similar to Uber, due to the prolonged period of unprofitability that this business had gone through, the free cash flow multiple comes out quite sporadic. So if we simply go down over to the last 12 months view and adjust the timeline to more recent times, you'll see that it has consistently gone down as they have raised their free cash flow margins during this period. And it now sits at the lowest free cash flow multiple this company has ever traded at. Similarly, if you pull in the trailing EV to EBIT, it seems that Airbnb is actually trading near its lowest EV to EBIT multiple on that front as well. Now, if you enjoyed today's content, you can actually get 2 weeks of our highest tier FinChat Pro subscription completely for free. There's no card details required, and we automatically apply the trial to your account once you sign up with the link down below. For more content like this, you could check out the top 5 most insane charts of 2024, which should be on screen now. Thank you for watching and have a great day.